All right, so last class we're talking about relatives. So I have a firm here. This is Walmart. So just to get you used to how you state it, the language here, we see that Walmart is trading 10% rich to its industry, which is 4% rich to its history. That's using PE ratios. So they're currently trading 10% higher PE. So it's real simple. You just take their PE divided by the industry's PE ratio. So it's PE ratio versus PE ratio. So 110, 10%. They've historically traded a 6% premium, so they're about 4% rich. Versus the S&P, they are trading 7% cheap, which is 14% cheap history. So here they're trading rich to their industry or cheap to the S&P. Why? Probably because of the growth stocks, the tech stocks. So tech stocks are trading rich to everybody else. So everybody else is trading cheap to industry, but Walmart's trading rich. Now, one thing I don't understand with Walmart, I don't know why Walmart has suddenly gotten so expensive. Oh, I'm sorry. Just suddenly their PE ratio is 45. That's way too high for Walmart. They should be in the 20s. I don't know what's recently happened with them. They have had really strong profitability recently, but that's just a crazy PE ratio for them. They may even be higher than Costco now, which Costco has been trading pretty rich. No, Costco is still more expensive. So these companies are trading really rich right now. And they're still cheap to the market because tech stocks have been so rich. On the EV to sales, which is probably what I would use for a Walmart, and we'll talk about that tonight. Why would you use EV to sales? Say Walmart is trading 57% cheap to the industry, which is 18% cheap to its history. That makes sense because they're a discount store and their industry is not as discount as Walmart is. So they should trade cheap. Why they're trading cheaper today, when they're trading richer on earnings basis, somewhat implies that their margins have been protected better than the industry. And then you look at the S&P, Walmart is trading really cheap here. 86% cheap to the S&P 500, and which is 39% cheap. It's history. So you expect them to trade cheap. Why? Because their margins are so thin. So a dollar of revenue is not going to be worth as much valuation. So you're going to have to work this in somehow to your paper. You can also definitely bring in percentiles. See where they are today versus where they've been. So the 10% is 0.38. Today they're at 43. So they're at an unusually low valuation to their industry. Extremely well, they're at their lowest. I mean, they're at their 10%. But this is a few months old, so or even a couple years old, so you can't really rely on this today. All right, so we'll get into that more. All right, so we're going to get into relative value tonight. I did grade all the paper 4s that I had. I didn't think there was any chance to get them all done, but so many of y'all didn't turn in the forecast. That saved me quite a bit of time. But yeah, this weekend was ridiculously busy, but I just Sunday afternoon I said I'm going to get them all graded, so I worked really hard at it. You can resubmit. You have the rubric. we might have a class where we're going to just talk about how you're going to resubmit your papers so you can get that organized. We'll see on that. Maybe we'll do that next Tuesday, just to let you get really organized with your group on what you're going to resubmit, and on your individual papers what you're going to resubmit. So any questions about paper 4? So you can submit your forecast and get one resubmission on that, but you only get one resubmission. All right. So if you didn't turn in the first time, I don't count that. So the grades look really, really horrible because there was very few forecasts submitted.
I didn't realize I did send you the wrong one. Like when you send me the.
Oh, yeah. It just stopped. Yeah.
So if I resubmit it now, will you give me another resubmission of that?
Yeah. Well, I'll only grade whatever's after that unless it's a completely different paper.
Okay.
Remember on the resubmission, if you resubmit, if you don't highlight what you change, I'm not grading it. I'm not reading your entire paper again. I get really burned out this time of the semester, so I know y'all never get burned out, but yeah, I get really, really tired. So I'm not grading your entire paper twice. All right, put your phones away. This class has some iPhone users that just make me want to quit my job immediately. All right, let's talk relative value. Some of y'all have seen this before, but boy, this is extremely important that we have good understanding on this. Everybody uses relative value analysis in investing, even though colleges don't really teach it. I saw Demodoran talking on this, so I stole some of his stuff on this particular presentation. But just the idea that colleges don't teach it, but everybody's doing it, he finally threw in the towel and says, well, I better teach it. So how does relative value fit in with the other two ways we value stocks? I'll give you the real estate example because that's the most common way we do it. And then we'll make sure you're using the correct relative in your paper 5. So there's 3 ways we value stocks and assets: fundamental analysis, technical analysis, and relative value analysis. Oh, I forgot to tell y'all. Let me show y'all. I think I sent it to y'all, but so you do have the video out there now, right? Y'all looked at it. We already have 35 views. Even got 1 like. It's pretty amazing.
In this case,
It's not my most popular video. The still that option video has 130 something thousand views. I don't know why. It's a ridiculous video, but this walks you through most of paper 5 except for capital IQ. So stuff we've seen in class, but it walks you through, so you could somewhat use it. At the very end, I do the data table. I showed you how you could do this with the H model. That's not in this video, but you could do it with the H model. One thing I did in this video, which I liked a lot better than what I showed y'all, is I started with my base case. So my base case with 4% and 0.5. I put that in there first, and I made sure I had 5 on the left and 5 on the right, about 4 above, 4 below. I made sure, I think that's my one. I made sure that was right in the middle, and then I built everything around it. So I recommend that. So you have your base cases right in the middle of the chart and just build around it. All right. So this applies to both assets and securities. So on the asset side, fundamental analysis, you can value the S&P 500 as an asset. I've done that before. You can look at the S&P 500 and look at its free cash flow, give it a discount rate, which is pretty easy. What would your beta be? If you're valuing the S&P 500, be pretty easy beta, right? You don't need the risk-free rate. You just get the expected return on stocks. You can value the S&P, you can value small cap, you can value Europe, you can use fundamental analysis. So this is this kind of cash flow analysis. It's a lot of what you did in paper 4, looking historical and then forecasting out into the future and then giving the present value of that. Technical analysis we'll talk about in this class. I do want to expose technical analysis, but we're not doing it in any of the papers, but you need to have some exposure in that. You can definitely do that with asset classes. You can definitely see if the S&P is trading in some range or whatever. And in relative value analysis, what we're going to talk on here, you can use that for asset classes. We do that in the investment society. Right now, large cap growth stocks look really expensive versus small cap value. And then Europe and your emerging markets look really, really cheap right now for good reasons. That relative value, you can say, where are they today versus their history? You can see what's really trading expensive. You're going to be doing it on the security level. Your paper 5, most of it is fundamental analysis, but you will do some relative value analysis. But good old discounted cash flow analysis. We won't do any technical analysis in here on that paper other than just covering the topic. And then the relative value, you're going to do it in two ways. One, you're going to use it to come up with your final terminal value for the capital IQ model. And then you'll give yourself a range for one of your football field charts. I'll show you how you can do that. But those are the three approaches. I can't think of any other approach that anybody uses besides those three approaches. You might say there may be factor models, but factor models are going to have some combination of these three things. So hedge funds that do factor models, they're doing fundamentals, technicals, and relatives. So what is relative value? You're taking market price and comparing it to something. Usually some accounting measure, but doesn't have to be accounting measure. I've done some. Well, you can get really creative. So I was curious about how expensive Tesla was. So I took Tesla's market price and divided by how many cars it produced. And I compared that to GM and how many cars it produced, and Ford and Toyota. And Tesla was off the charts. This is back before they were doing hundreds of thousands of cars. So there's a point where their car production was a fraction of Ford and GM, each one of them. They're a fraction of each one of those. And yet their valuation was greater than all of them added together. So you look at Tesla versus how many cars it produces. So you don't have to just use accounting data. You can use other data to try to see how much people are paying for this company. We're going to be using fundamental prices, fundamental factors like earnings, revenue, and book value. So you're going to have some measure of value over some fundamental factor. Your measures of value are either price. You probably should put in your notes, it's price or market cap. You don't always use price. You can use market cap. So market cap is price times all outstanding shares. Anybody remember what enterprise value is? Yeah, I use it all the time. So what is it?
That is the equity value plus the market value plus the value of debt minus excess cash.
Well, I don't know what you mean by excess cash, but I say cash. What do you mean by excess cash?
Just cash.
Is cash? Yeah, I was thinking you might have a theory there that I hadn't heard before. So enterprise value can be less than market cap if they have more cash than debt, like an Apple. So it is possible. You don't normally, we can see with Apple, well, they don't calculate Apple's cash correctly. So let me try Microsoft. So their market cap, let's see if we can find their enterprise value. Their enterprise value, well, they're almost, so you get their enterprise value actually is lower slightly. Enterprise value can be slightly lower if you have a lot of cash, so it doesn't have to be higher. So market value of the firm plus its debt minus cash. Really, really key for picking which factor you're going to use. So we're going to use earnings, revenue, and book value, but there are many, many industry-specific factors. None of you are doing utilities, but utilities almost always do enterprise value to regulatory assets. The regulatory assets are those assets the regulators allow them to price off of. That's a very common approach. So firms have their different factors that they like to use. A good example of real estate, none of you are doing real estate companies, but they usually use funds from operations, FFO. FFO is a really real estate term. So, industries have their own thing. So relative value essentially accepts that markets are well valued. It is possible to use relative value to see if the entire market's overpriced. I'll show you how you can do that using some regression analysis. But generally, we accept that the markets are well valued. We're trying to see within markets what's mispriced, what's overpriced, what's underpriced. And we use these terms. I don't know who came up with these terms. I keep waiting for a UTSA alum to be the beginner of terminology. Someone many years ago used the terms cheap and rich. I wouldn't have said that. I would have said inexpensive and expensive, but they use cheap and rich. To me, word cheap has two connotations. It can be inexpensive or just low quality. Maybe that's what they meant. Maybe this stock isn't really inexpensive. It's just really bad quality. And rich is even worse. Rich, I mean, that really doesn't tell you. So expensive makes more sense there. But those are the terms we use. So let's talk the real estate example. So let's just look at price. Now you might say, well, this is ridiculous, but I've heard this conversation. We almost got embarrassed once we had the investment society presentation and a student said this, and I was hoping that the judges didn't hear it. It's like, please don't hear what they just said. I heard people say, wow, Microsoft is really expensive right now. They're trading for $418. Can you tell Microsoft is expensive by looking at their stock price? What could they do tomorrow to cut that to $100? 4-to-1 stock split, right? So it's a completely fictitious random number, but students like, wow, Microsoft's really expensive. No, they just don't have many shares outstanding. They could cut that in half anytime. But what if that's all you had? That a house is, oops, sorry. Yeah, Costco's got, no, sorry, I lost it. Yeah, there are some stocks, you think about Warren Buffett when he had his, $100,000 share per share stock to try to keep the riffraff out. So you're looking to buy a house and all you know is its price $150. So you're going to buy a house without looking at it for $150,000. That sounds pretty cheap. You don't know what city it's in, what neighborhood it's in. It could be on the cliff in California that's falling into the ocean. You just don't know. So you can't buy that. What if I tell you 2 other houses in the neighborhood are trading for these prices? That's kind of like saying Microsoft is trading for, or Walmart's trading for $70 and Microsoft's trading for $500. Does that tell you should buy Walmart? You don't know the size of the house, right? You don't know how many square feet it is. There's a lot of things you're missing. So that's not enough information. So price by itself, even comparing to other prices, just doesn't tell you anything. We need to relate this to something. So the first price relative we'll use is price per square foot. That is a price relative. So this house costs $75 per square foot. Comparable houses are $250 and $225. Would you buy it just based on that? So you know something now that there's something wrong with the house. Isn't that what your mind's thinking? There's something wrong with this house. Maybe it's really old. Maybe it's falling into the earth with a bad foundation. But you're more tempted now than you were before. This is similar to saying Microsoft is trading at a PE of X versus somebody else. And that is helpful information. So Microsoft's PE ratio right now is lower than Walmart's. Walmart's trading at 45, Microsoft's trading at 34. Does that mean you should buy Microsoft and short Walmart? Maybe, maybe not. I can't tell you why Walmart's so expensive, or Costco, right? Buy Microsoft, short Costco. But we'll talk about what that ratio is telling you. There's a little bit more that we need here. We're limited here to square foot. What we're missing is something on risk. So we got to get something on risk or we're not going to really have a good analysis here. So let's say we build a massive model. This is what y'all did for project 1. Y'all don't remember. You brought in all this data to run regressions to try to figure out what is the market looking at. So let's say you go out and someone has done this. I found a website that does this. Zillow probably does this. You look at everything you possibly can that influences the value of houses. You put that into a model. Some of them are related to quality or value, the size of the house. We already took care of that with the price per square foot, landscaping, how old the roof is, the ages of things, how nice the kitchen is. And if you walk in and the kitchen isn't nice, think, okay, that's going to cost me $50,000 just to remodel and redo that. I've been amazed how expensive remodeling is. The kitchen is pretty expensive. Got to knock out walls and all this kind of stuff. So you look at those kind of things, put that into a model, but you have to, and it's really important, you have to have something related to risk. Remember on project 1, we had things related to value and related to risk. We used the Bloomberg probability of default as our risk measure. You can use debt to equity, you can use beta, but you want something related to risk. Now, I might have left out stuff that would be important to you, but I just was making stuff up here on risk. I don't know if these are the greatest risk numbers there. My parents' house, I sold it, and they had foundation problems. I had to tell the buyer about it. It's kind of obvious. He did an inspection, but I don't think he did. I think he told me he did an inspection just to kind of like scare me or something. I don't know. And he said they didn't find anything. It's like there's like cracks all over the wall. How could you not fix it? So I fixed the cracks. Fortunately, my parents had had the foundation repaired and they had this guarantee that if anything went wrong, that they would refix it, and we had paid the premium for that, so I could send that guarantee to them. But foundation issues are pretty serious. You got to worry about that because it's going to cause major issues. So if you do that, you get a 91 R squared with 350 houses, and it tells you this house should be trading for 150 bucks, and you can get it for 75. And they tell you, hey, you've got 5 seconds to make your decision. If you don't make a decision, we're going somewhere else. Would you buy the house based on that? This is like running our model and finding that this stock is really, really cheap. What was our model missing? Project one, anything about the future. Everything we looked at was historical. So if you don't have anything about the future, like you don't know that a really horrible person is about to move in next door, and you would know that if you went and did a little more analysis, that might be interesting. That's not going to be in your 91 R squared because it doesn't have any futuristic numbers. Or if there's going to be some new law passed that's going to, you're going to lose half your land. I saw one woman was on TikTok that her backyard the city was threatening to take it over, make it a city park. And she's like, yeah, I wish I'd known that when I bought it. So that's that 9% we don't have. But are you more tempted now to buy it? You could have done that with Project One. You could have Project One taken all the stocks that had the biggest difference and bought them, and all the stocks that had the biggest positive difference and shorted them. How would your model have done? Who knows? You could have tried it and set it up as a paper portfolio. Could we get better? Could we figure out what is it that other 9%? Let's say we put in 2 more factors. Was anyone murdered in the house? Is it considered haunted? And that gets your R squared to 98. And now your valuation comes back to 80 bucks. So now you know something, right? Something happened in the house. And you might say this is not important, but look at this article I found. Hong Kong property values. Rumor has it that nuns were beheaded during the Japanese occupation, the Second World War. They haunt the shadowy halls. Ghost inhabited homes lose 1/5 of their value. The prices on flats on the same floor drop as much as 9%. Murders kill the price by 34%. So it does matter. All right. Would you buy a house that's considered to be haunted? Be kind of fun, be cool. I probably told you all these stories before, but there's a lady in Lotus tells her haunted house story. It's like, why are you telling this story? No one's gonna ever buy the house. But she's such an entertaining storyteller. It's really a fun story to listen to. I thought she was joking, but she wasn't joking. But you would buy the house and you'd be willing to take the discount, but you'd probably be pretty nervous the first few weeks. Maybe it's not haunted, but there may be some weirdo living in the attic that's causing things to happen. Who knows what's going on. Homes do not mean haunted, be tainted by death. Those near cemeteries, funeral parlors are cheaper too. That may be our problem, right? I could have added that in. Would you live across the street from a cemetery? I kind of like it. You have quieter neighbors that way, probably. So anyway, this is not like some joke article. This comes from The Economist, so it's a pretty legitimate group there. So that is important. So would you buy it now? So let's say you found something analyzing your stock that the market's really, really finding important that you don't think is important. So they're valuing something that you just think, I think I had a gentleman speak to this class years ago. He was talking about Apple, and he did exactly what you want to do as a security analyst. He said, I think Apple's undervalued because the market is missing this one thing. That's what your boss wants to hear. So the market is wrong for this specific reason. You don't say, I think the stock is cheap. It's cheap because the market's misinterpreting that. So his whole argument on Apple was that everybody was assuming Apple's margins were going to decline. And he didn't think they were. He was looking to the court cases between Samsung and Apple. He was looking at what was going on in Apple and other countries. He said the market's getting this entirely wrong. All right. So that's the one thing, that's the first thing. You need two things. The first thing you got to say it's cheap because the market specifically is getting this wrong. You can't just say it's cheap. You got to say what the market's getting wrong. And what's the second thing you need? Anybody know? You look at your model and the market's really focusing on that too much. The stock is cheap. What does your boss want to hear? Have y'all heard this word before? No one knows, no guesses? Y'all know that word? What's that word mean? Well, we got the reason, right? They're misinterpreting Samsung. So you're smart. Market's dumb. Your boss says, okay, that's great. Apple's cheap. What does your boss want to hear now? When does the market get as smart as you? That's what a catalyst is. And that's the second thing you hit. Okay, Apple's cheap because the market's misinterpreting what's going on with Samsung in this court case. And the market's going to figure out in the next two quarterly earning releases. This is going to take them 20 years to figure this out. They're going to figure out because everything's hitting the news. Everybody thinks they're expecting their margins to drop the next two quarters. I don't think they're going to drop the next two quarters. They're going to win this case. And it's really not going to have that much impact on them. They're still a premier product. That's the two things you need your boss wants to hear. So market is wrong on this because, and they're going to figure it out. So you can't just tell, the market's wrong. Well, when they're going to figure it out? Well, I mean, so you might say NVIDIA is overpriced because I don't think AI is really going to take off. Well, when are we going to figure that out? Well, over the next 20 years, we're just going to know, 20 years from now, we're going to look back and say AI really wasn't that great. Well, your boss is probably going to be retired and long gone in 20 years. So you got to get it. You got to find something that the market got wrong. And then what is the catalyst to change it? It could be, this is a great company, but poorly managed. They're going to get new management. And I think they're going to get new management in the next 6 months. There's an activist investor out there. I just think they're going to come in. New management would change this firm. I think it's inevitable. That's the kind of thing you want to say. The problem with this is that's the risk of it. You got to be really specific. Your boss loves specificity, but it also means your boss going to know that, boy, you really blew that. So if you want to be a good analyst, you need three things. The market's wrong because, very specific, not generalisms. The market's wrong because this is a really good company. No, that's not it. You gotta do better than that. The market's going to figure out I'm smart and they're stupid once this happens, and it's going to happen in the next 6 months. And then you got to be correct. If you do that, you're going to be making 7 digits your career. No problem. You'll be a very, very wealthy person. This gets back to what did well, at least first two, remember what the Motorin said? This is the storytelling. You got to be a good storyteller. You got to get your boss, like, let's go buy it now and get out there. You got to get that excitement. And this is how you do it. The Motorin says we're too much into our models and all these things. It's like it's 12.3% cheap because I ran this regression, all that. And no, your boss is going to listen to stories. Be specific. So I might try to find an analyst, have them talk to this class. I haven't set up any speakers yet, but I'm thinking about it after Thanksgiving to see if I can get a couple. I think I can find him on LinkedIn. Really a good analyst. I'm sure he's doing extremely well now. So you think this stock is cheap. You think it's worth 150. The market thinks it's 80 because there's two things they're looking at that you don't think important. So you think you can get a $150 house per square foot house for 75, but the market thinks worth 80. So that can be fine. This is where the catalyst comes in. That can be fine if you plan to hold the stock for a long time, or you expect the market to change its opinion short term. If the market is pricing something that they're going to keep pricing for the next 10, 15, 20 years, then you have to become a Warren Buffett and you just buy the stock for the long term. You're a long-term investor. If you're an active trader, you have to have that catalyst, and it's got to be short term. Really, really critical. So make sure when you're talking to your boss, you have both of those in your treasure chest, because that's what they're listening for. Now, when I was at USA, I was an analyst, security analyst. I could never get their process. It never made sense to me. The most shocking day of my life is the president, the head of the entire equity department, a guy named Harry, real nice guy. He comes out of his office and he goes, "Hey, Ron, how you doing?" And I go, "Oh, fine." He says, "Yeah, I like to come out sometimes and just see what the analysts are thinking." And I was like, "What are you talking about? You got like 40 analysts and you don't talk to your analysts?" "No, I mainly just use street research. I don't really, every once in a while I'll talk to them." It's like, I'm thinking, why are we paying all these people as analysts if no one's listening to anything? That's what USA's model was. They had analysts out there because you're supposed to have analysts, but the portfolio managers were just doing their own thing. Does that make sense as a business model? They outsourced all of that. I took that guy's job like 10 years later, which was really shocking to me. But they outsourced a lot of it. We had a few still in-house, but it just this makes no sense to me. It was just very confusing to me. So they weren't really using those analysts very well at all. But if you're going to be an analyst, you've got to get your boss to make trades, and that's how you're going to do it. And you've got to think about catalysts. You always got to have that on your mind and what the timing of that is. So become a good storyteller, and you'll become a very, very well. Don't forget the third thing. If you're really good at this and you're bad at this, eventually it's going to affect your pay. But if you can put all three, and that's where I think this guy Jason I'm talking about, I think he's good at all three of them. He's a really good story. One thing I saw with Jason, if I can get him back, very similar to what Demoterin did. He could, in a paragraph, completely explain his investment thesis. And that's what's going to be your job when your group does your final paper. How do you get that massive analysis that you did and synthesize it so that people get excited reading why you're recommending what you're recommending? And he could do it. And we were just he was a tech analyst. We were just throwing tech stocks out to him, and he could just real quickly in a paragraph. That's where you got to be in your career. You're not going to be there in the next 3 years, but in the next 5 years, you get there, you're set for life. You're going to do great. So this is the key to success as an analyst. All right, so how do we bring this over to the stock side? Well, we're not asking if the stock market's expensive or cheap. We're just looking at this one house we're thinking about buying. So the key here is we're looking at fundamentals. We're looking at risk. With stocks, we'll look at a lot of generic things. That's what we did in your model 1. But then you can also do things specific to your industry. One thing we didn't do in your first paper is bring in things like inventory turnover or receivable turnover. With airlines, you can do available seat miles. There's ratios that you can get really specific with, but the larger your database, the more difficult it is to get specifics. So, airlines is one of the easiest ones to do because they all use the exact same data. But with airlines, you have to go international. You have to bring in non-US companies. Auto is pretty tough because you have the credit side of that, the Ford Motor Credit and GMAC and all those. So it makes it a little more difficult. So we get generic. So y'all did a generic analysis for paper 1. We had fundamentals in there. We had risk factors. Remember, we broke them up between turnover, margin, return on capital, and risk. We had those 4 categories. But you have to have risk factors in there. If you don't have risk factors in there, you have a stock that looks cheap, but it's really just really risky. You're just buying risk. All right. You have to have the appropriate price relative. We'll talk through that. What's the appropriate one for your company? You have to have the correct fundamental values and the correct measures of risk. So essentially, and this is what we did. On project one, you had fundamental risk factors. Those are independent variables trying to forecast the dependent variables. Now that's regression. We didn't do regression. We could have done regression on your project one. I don't like regression because you get really bad slopes and you get really bad statistics. So I like the ranking model, but it's essentially the same approach. So you're trying to figure out what their PE ratio should be given their fundamentals and their risk, and then compare that to what the PE ratio actually is. What we did was with ranking, figure out what their ranking should be given their fundamentals and risk, and see what their valuation ranking actually is. And we're comparing it to it. It gives you a little bit better model that way. Higher fundamentals should give you higher values or higher rankings. Higher risk should give you lower values and lower rankings. I love this slide. I would carry this around in your wallet if I were you. I think it explains so much of finance. So you're doing this on paper 5, the dividend discount model. Your stock's worth dividends divided by KE minus G. Let's break this up some. What are dividends? Earnings per share times your payout, right? You agree with that? Your dividends is earnings per share times how much you're paying out. What's your KE, risk-free rate, plus beta times the market risk premium. G is your growth. What happens if we divide both sides by earnings per share? We get a PE ratio. So this ratio right here is so critically important. I encourage you to read the Motorin's second book. Motorin. Let's see if he comes up. This one, the little book evaluation. I forget which chapter it is, but is there a look inside? Read sample maybe. He's got a chapter 4. It's all relative. Guess what he's talking about there? So what he does in that chapter, which I haven't done, I should probably add it. But he does the same formula, but for price to book and EV to sales. He does it for other ratios. For price to book, you have to bring in return on equity. EV to sales, you have to bring in margins. So he brings it in. So he's explaining what are these ratios telling you. And the reason he's so picky about this, and me too, is a lot of people use PE ratios without much thought. And what he argues, when you use PE ratios to pick stocks, you're essentially summarizing massive amounts of information into one ratio, hoping it's telling you something. So let's look at a PE ratio. So a PE ratio is the payout, what percentage of your earnings you pay out as dividends, divided by an interest rate, plus individual stock risk times overall market risk minus growth. Let's start with the first thing, interest rates. We're dividing by interest rates. If your interest rates go up, what do PE ratios do? You increase your denominator, what should your numerator do? I mean, what should your ratio do? Should fall, right? Higher interest rates should mean lower PE ratios. When I graduated from high school, before your parents were born, interest rates were 15%. I had a CD that matured at a bank at 15% that I could have rolled over at another 15%. I said that was just not a very good rate. I wasn't going to do that. PE ratios were like 8 or 9 for the S&P 500. Today, they're in the mid-20s. Back then, PE ratios were really low. I can even show you mathematically. So here, I didn't do it to interest rates, but I did it to inflation. And I graphed monthly PE ratios for the S&P 500. And you can see when core inflation is low, PE ratios are high. When core inflation is high, like back in the late 70s, PE ratios are low. You can see they drop below. Here's PE ratios, here inflation. So when inflation was high, PE ratios were below 10. So you might say, wow, PE ratio below 10, that's really cheap. Well, in the early 80s, that wasn't cheap. That was expected. Credit Suisse has always said stocks are expensive if the PE ratio plus core inflation is above 22. You can kind of see that here, right? Here's 20 and there's 2. He's saying if PE ratios are above that line right there, here you got 18 and 4. So their line kind of matches that. So PE ratios plus core inflation, if that's above 22, stocks are expensive. When I did this chart a couple months ago, this is where we were. We had 4% inflation and PE ratios at 25. How does that look? Expensive or cheap? We should be down here. We're up there, pretty expensive. But we were further up here when inflation was like 6%. Well, maybe that was where we were. So inflation 6%, we looked expensive. You may know what these dots are. What period of time was that? Not the 70s. When?
Eddie's?
Say that again.
90s.
90s. You're getting closer. Yeah, I guess the 90s. Yeah, this is the .com. So late 90s. Yeah, so you're right. Yeah, if you say like late 90s. Yeah. So late 90s, 98, 99. Yeah, we were way up here. Very, very expensive. I showed that to Investment Society, I think last meeting, just how expensive NASDAQ was back then. This is the S&P, but it was pushed up there. So pretty good relationship. The R square is not massive, mainly because these periods up here really distorted it. So we're definitely expensive right now. We're probably moving because inflation is falling more down in the 3 level. We're probably kind of over here, but we're still well above that line. But there is definitely a strong relationship between interest rates and inflation and PE ratios. So back a few years ago, interest rates were so low, people were saying stocks look really expensive. They weren't as expensive as you would have thought, given how low inflation was back then. They were expensive, but it wasn't massively expensive. The second one is overall risk. So this MRP, how do you measure MRP? Probably the easiest way is to look at the VIX. Do y'all use VIX? So I think I mentioned I've met the lady who invented the VIX, a professor at Rice University. She doesn't get credit for it. The person she did it with gets all the credit, but she was involved in it. She was very, very proud of that. But the VIX, what did the VIX do after the election? Rise or fall? What does VIX do after an election? It fell quite dramatically, right? Why did it fall? Because we knew the results of the election. Okay. So uncertain. Some people talk about VIX as a measure of risk. It's really a measure of uncertainty, how much uncertainty there is out there. They're not saying that, wow, Trump is less risky than Harris. They're just saying we now know it's Trump. We were looking, I think, in one of our Investment Society meetings at previous elections where the election wasn't decided on election day, like Gore versus Bush. Their VIX stayed pretty high until it was finally elected. I think Gore did us a big favor by conceding, probably before he really had to. He probably could have taken it through the courts more than that. But it definitely dropped once it was decided. So, but usually you'll see it drop right after. You'll see the same thing after jobs reports. So when the VIX is high, PE ratios are going to be low because your denominator is going to be higher. So if you want to think of this in terms of the VIX, that's probably a good way to think about it. But there's a correlation here, which is really important. So you go back to 2008. What did the VIX do in 2008? Shout up. What did expected growth rates do in 2008? They dropped. What did the stock market do? Crashed. Right? When you have risk going up and expected growth coming down, you're going to get major 30, 40% type of market crashes. All right. So PE ratios are higher when interest rates are low and risk is low. They're lower when interest rates are high and risk is high. These apply to all companies equally because they're the same numbers. And then we get to the beta and the growth. A risky company should have what kind of PE ratio? If you raise the beta, what should the PE ratio do? Should be much lower. All right, so why is Walmart's PE ratio so high? Is it because it's low beta or high growth? Could be both, but a 45 PE for Walmart and a 50 something for Costco just seems insanity to me. They are low risk, so they should have higher PE ratios, but not that high. I love Costco. I keep waiting for the day I can buy Costco and its price just keeps going up. So one of these days it's going to crash, but it probably crashed because they did something stupid and it's not the same company anymore. But you could certainly argue that Costco should have a high PE ratio because their beta is low. And you can compare that. We look at Costco PE ratio of 56, and you compare that to a competitor, Nordstrom. Nordstrom is 13. Why is Costco 5 times more expensive than Nordstrom's? That can't all be beta. Definitely, look at that beta. Their beta is really high, and Costco's beta is really, really low, but you're going to need more than that to explain that huge difference. Or even just look at, Nordstrom's at 13. Macy's is at 23. Why is Macy's twice as expensive as Nordstrom? So, you think back to your beta, maybe Nordstrom's has more debt. That could be part of it. Maybe has more fixed costs, but you wouldn't think these two firms were that radically different. So Macy's has been a 6 or 7 PE stock here recently, and now they're back up to a more reasonable PE ratio, or their earnings have just come down and their stock price didn't fall. So a PE ratio, and this is where people forget, PE ratios can be high, not just because they're high growth, but also because they're low risk. And that's a pretty important number to keep in mind because it's very material to valuations. And then the last one is growth. High growth because we're subtracting growth. So all these numbers higher give you a lower PE, lower give you a higher PE. On growth, it's just the opposite. Higher growth gives you a higher PE, lower growth gives you a lower PE. So if we look at NVIDIA, do you think NVIDIA is higher or lower than Costco? Who has a higher beta, NVIDIA or Costco? NVIDIA. Who has higher growth? NVIDIA. So they're higher on both. So it's hard to know right off the top of your head which is higher. NVIDIA is higher, 69. So that's probably higher. That's probably all higher growth. But their beta is 166. Costco's beta, I'm sorry, I'm using, I always say beta is not a number you look at in Yahoo Finance, but when you're in a hurry, it's perfectly fine. Costco's beta is higher than Walmart's. That's really interesting, right? Their beta is higher than Walmart's, and yet their stock's trading much more expensively. Why are they expecting so much growth out of Costco? It's interesting. I'd love to buy this company, but I just can't buy at those prices. All right, so for the overall market, high interest rates, high risk gives you low PEs. For individual stocks, low betas, high growth give you high PEs, high betas, low growth give you low PEs. Now we left one number out. What's the one number we left out? The payout ratio. Why can't we ignore the payout ratios? Any guesses on that? We talked about sustainable growth. Y'all remember that formula? ROE times what? Right, remember? Sustainable growth, ROE times retention. What's retention? 1 minus your payout. What do we say with sustainable growth? So higher retention, higher growth. That's the theory, right? What does that mean for higher payout? What does that equal? If you retain more, you should grow faster. If you retain less, what should happen? If you pay out less, what happens to your growth? When you pay out more, what happens to your growth? Higher or lower growth? Lower growth. All right. So what does that imply? If you increase the payout, what else is going to happen? You're going to reduce the growth. Almost magically exactly the same. So we can ignore payout because if you pay out more, your growth comes down. Those two exactly balance each other out. So you just ignore payout entirely. It's kind of a nice a nice kind of attribute. It's theoretical, but the theory helps you really understand how stocks work. Now, when you get the price to book, then you bring in the concept not of growth, but a return on equity, which we just saw return on equity, right? Return on equity was, growth was return on equity times retention. So it's not that hard to get the price to book into this formula. EV, the sales, then you got to bring margins in, and then it gets a lot more complicated. But the motoring goes through that. Unfortunately, I was on my bike, so I couldn't write it down. But he goes through those formulas. You'll see them in textbooks. They're interesting formulas. This is the one you should really remember. There's a massive amount. Anytime you're talking about PE ratios, you're talking about two general things, interest rates and overall risk, and two company-specific things, company-specific risk and company-specific growth. You're talking two things that are general and two things that are specific. Anytime you look at a PE ratio, make sure you're thinking about all four of those things, that you don't leave one of them out, right? Any questions on this? Can someone give me that formula now? PE ratio equals what? Any takers? You got it, Omar? Without looking? Oh, don't look at what you wrote down. Can I do it? So payout ratio over risk-free rate plus beta times market risk-free times growth. You just do the dividend discount model and just substitute payout for dividends and you got it. These are old numbers, but Tesla was real expensive back then. I don't know what they are now. I haven't looked at Tesla in a while. PE ratio is 94, so they've come down quite a bit. Even with with the election spike. Boy, that's crazy. Now Kroger looks really cheap. Now Kroger's beta would be what? High or low? Pretty low beta, so they should have a high PE. So the market must be really negative on their growth. We do know at the time I did this, Kroger had really high debt. That's going to push their beta up and not substantially. So Kroger looked pretty cheap there. You look at them today, they definitely have come back some. Up to 15. So they've come back some, but they're 1/3 the value of Walmart. Walmart's at 45, they're at 15. Their risk should be really, in fact, Kroger has higher debt, but they should have a lower beta than Walmart, even with the higher debt. So the market's telling you they really hate Kroger and they really love Walmart. You got to kind of assess that. Someone's doing Kroger in here, right? Or not? Yeah. So why is that? I mean, that's a huge difference. And it's going to be interesting when you do the historical approach to see if this is really unusual for Kroger, as Kroger's just always been really cheap like that. Walmart was at 29, now they're at 45. I have to admit, Walmart's done exceptionally well this last year. It's really pretty amazing. But has the market gotten way ahead of that, paying $45 for $1 of earnings? I mean, that's just pretty expensive. Amazon, expensive. So the question is Kroger cheap, slow growth, high risk? We know they're not high risk. So cheap, slow growth, or some other combination. Is Tesla rich, high growth? Yeah, probably so. Low risk, probably not. They're an auto manufacturer. So those are the kind of questions you're asking. We're not asking about the overall market. That's where interest rates and the market risk premium come in, but they're all using the same interest rate market risk premium. So those wash out. So we're really talking about beta versus growth to individual stocks. All right, so here's where you get into your capital IQ model. Your numerators are going to be price or enterprise value. Price is only the stockholders. Enterprise value is stockholders and bondholders. So what is EBIT? I know y'all know it, but just say it so I know you're awake. Earnings before what? Interest and tax. All right. So I heard students say earnings for income tax, and that's not the right answer. All right. So who owns EBIT? Stockholders or stockholders and bondholders? Both or just stockholders? So anything that's before interest belongs to both of them. because you haven't paid your bondholders yet. That's their money too, until you pay interest. So what ratio would you use here? The enterprise value to EBIT. All right, y'all remember this from the investment class. Hopefully you haven't forgotten that. What about EBITDA? What would you do there? Price or enterprise value? Enterprise price. What about earnings per share? Price. That's after interest expense. All right. Book value. That's assets minus liabilities. So the debt holders are taken out. So that belongs to stockholders. So it's price to book. What about revenue? Who owns revenue? Is that before interest expense or after interest expense? Before. So who owns revenue? Both of them. So use enterprise value. If you do price to revenue, you're going to find cheap stocks that aren't cheap. They're just high in debt. If you add the debt back in, you get a much higher enterprise value. And then that's going to raise your EV to revenue. It doesn't look so expensive. All right. See if y'all remember this from the investing class, those that took it. What's the one that Yahoo Finance gets wrong? There's PE ratio, trailing and forward. Y'all know the difference between trailing and forward? So trailing is your price over your last 12 months earnings per share. Forward is your price over your forecast next 12 months. All right. When you use the PEG ratio, you use the forward ratio. What about this one? EV to EBITDA, does that look right? Right? Before interest, enterprise value, EV to revenue, that look right? Looks okay. Price to book, is that right? Book value belongs to stockholders. What about price to sales? That's the one that's wrong. Now, when Jason spoke to this class, he did a great job. You go, the PE ratio, the EV to sales, the price to book, the EV to EBITDA. I mean, he never, I sometimes will say, accidentally say price to sales just because I'm talking too fast. He never did. He always said it the correct way. Why they have price to sales in here, I don't know. Here's Kroger's price to sales is 28. EV to revenue is 38. It's one almost a half higher, 40% higher. So yeah, it makes a big difference which number of those numbers you use. Their EV to sales is 38. Costco's is 161. Absolute insanity. I mean, think about this. This is Costco, right? You're paying $1.61 for each dollar of revenue. What's going to happen to that revenue? 97% of it's going to disappear in expenses and cost of goods sold. You're only going to get 3 cents of that revenue. You got to pay $1.61 for $1 in revenue when 97% of revenue is going to get eaten up in expenses. Does that make any sense at all? You compare that to a Tesla. Well, they're 10, so I should have picked a different one. Tesla is just not a good one. Walmart, $1.11. Just makes no sense at all. These companies, I mean, in the past, they haven't been high. Just makes no sense why they're so expensive. Now, some firms like a Macy's, you can justify a higher EV to revenue because their margins are much wider. So firms with thin margins have very low EV to sales. Firms with wide margins, but we just saw Costco and Walmart have these ratios over 1, and they have thin margins. It just makes no sense at all. I don't know what the market's telling us. Y'all can see why I'm not buying Costco. Just doesn't make sense to me. I don't know how long it's been like that. It's been over 1 for quite some time. It just does not make sense. All right, so those are the ratios that we're going to use. Make sure you line them up correctly. Use price when it's only stockholders. Use EV when it's stockholders and bondholders. So here's your ratios. The PEG ratio, that's your PE ratio divided by growth. So in the Investment Society, we tried something really interesting. I can't show it to you because it's tied to Bloomberg. But the Motorin said PEG ratios are great, but what's missing? So you got the PE ratio, you got growth, that's your fundamentals. What's the one thing we're missing? You got your your relative, you got your fundamentals. What was the third thing we said we needed? What are we missing? The risk factor. So what the motorist said is, if you take PEG ratios. So we actually tried it. We have a portfolio going. I haven't checked it today. But we've sorted the entire market by PEG ratio. And then we brought in a risk factor. We used the Bloomberg risk factor. And what we did them by quintiles, highest PEG ratios, lowest PEG ratios. And on PEG ratios, low PEG ratios, we bought the stocks with low PEG ratios, but high quality standards. And then we shorted the stocks with high PEG ratios and low quality standards. So NVIDIA is one of the stocks we bought. NVIDIA's PEG ratio was actually not all that high. So PEG ratio is your PE ratio divided by expected growth. So far the portfolio has done well. We spent $1 on the portfolio and it's up like $7,500 in a few weeks. So we'll see if that continues. We're going to rebalance it every 3 months and see how that goes. But what is the motor saying? Well, PEG ratio by itself misses the risk factor. So just add that in. So we found a way to add it in. Makes perfectly logical sense. Do something like that. You are heavily dependent on how good of forecasters your growth factor forecaster people are. You know, you got some analysts out there forecasting, you're using their forecast. Better use your own forecast if you're any good at forecasting. But a PEG ratio fits into that earnings-based relatives. I did not pull PEG ratios for the file I built for y'all, mainly because it's really tough to get them consistently for entire industries. So it's a little bit tough. If you want to do a PEG ratio, one I would recommend on Bloomberg, they have something called the PEG-E ratio. I forget what it stands for, but that one usually gives you the best data. I forget what the Y stands for. So PEG-E ratio. Now, Jason, the guy I was talking to, had talked to the class, he came up with his own PEG ratio, and we've used it. So it's not your PE ratio, forward PE ratio, the future expected growth. It's your current PE ratio divided by the previous 5 years growth. So it's like a historical PEG ratio. So it's PE, the growth, and you adjust that for risk. So we haven't tried that with the Investment Society. That would be an interesting one. It's kind of like a historical one. Or even take the two of them together and come up with some type of analysis to see what's going on. We know that the market tends to extrapolate. Firms that have had high growth are expected to have high growth going forward. So you have to kind of worry about the reversion to the mean. But earnings based. Book value based, price to book value, or this one can work really well for you. I think Bloomberg has this, so this is one we might be able to add into the model. But take your price to the last 10 years of earnings per share. And that's the Robert Schiller approach. If y'all probably seen Robert Schiller, he calls it the CAPE ratio. So he does the PE ratio divided by inflation adjusted earnings. And he says stocks are the second most expensive they've been in history. They're not as expensive as the 2000 crisis. They're more expensive than the roaring 20s. What happened the last two times were that expensive? In 29, was that a good one? In 2000? So he's saying this is the second most expensive we've ever been. It's not a book value, price to book value, but it's really close. Because what is book value? Book value is the sum of all your earnings since inception minus your dividend payments. So he's saying, well, you have firms that are buying back more than their value of their stock. So they have negative book value. So you can't do price to book, but you can do price to 10 years worth of earnings. And you can use that as a substitution for price to book. So he actually thinks stocks are expensive and bonds, he's saying, some pretty reasonably valued because the higher the blue line, the more expensive stocks are. The higher the red line, the less expensive bonds are. So he says bonds are back to normal and stocks are really, really expensive. There's the 2022 sell-off. It came right back. Why? Because the Magnificent Seven just came roaring back where they were. So don't forget this ratio. I'm not sure if Bloomberg has that, but they might have a price to 5 years, It's 10 years. I'll have to look it up and see. I bet they have something like that. And then you have your revenue base relative EV to sales. So when do you use which one? So this is where you got to pick. It's a pretty long time. This is where you got to pick which ratio you're going to use. Every industry can do a PE ratio. So always look at PE ratios. They're always probably useful to the problem with PE ratios is if you have negative earnings. That's why EBITDA is really popular because you don't get as many negative numbers. The Motorin says the only reason everybody likes EV to EBITDA is because they like saying EBITDA. It does kind of roll off the tongue a little better. That's not a good reason to do a ratio, but it does help get rid of, if you're doing a model where you're bringing in 100 companies, you'll get fewer NAs with EV to EBITDA than you will with price earnings because you have fewer negative numbers. So it just helps out there. So any of these are fine. I don't know anyone who's EV to EBIT. So it's usually price to earnings or EV to EBITDA. But every industry does that, but especially technology, EV to EBITDA is somewhat just the go-to ratio that everybody loves to use. I have noticed in most models, though, that tech stocks tend to be more correlated to EV to sales for some reason right now. That's hard to say. But tech stocks, all companies and then tech stocks, book value are high capital requirements, utilities, manufacturing, maybe the chemical companies, firms that have. So the way you can tell here is just look at their property, plant, and equipment as a percentage of assets. If it's over 40, 50%, price to book may make some sense. So firms with a lot of property, plant, and equipment use price to book. Cyclical industries, we're not doing these. Well, there's materials there. So yeah, materials may fit in there. If your earnings go up and down with a commodity price to book is the best place to go. So you don't see because otherwise your stock looks really cheap and the price is high. Your stock looks so expensive when the price is low, and you can kind of whipsaw back and forth. So very cyclical commodity-based companies like energy and materials are going to use a price to book. And we're not doing these at all, but banks, insurance companies always use price to book. I keep starting these rumors that USA is going to sell its bank. I was telling my executive MBA class that, I'm like, oh, are you sure? And I have no idea. I haven't spoken to Wayne. Last time I saw Wayne was at the airport. It's kind of funny. I saw him like 2 years before he became CEO. And I go, hey, Wayne, why aren't you CEO yet? And he was like joking about it. It's like, and then he became CEO. But yeah, I haven't talked to him about selling off the bank. Next time I see him, I'll ask him, but he's retiring now, so he won't know. But they'd love to get rid of that bank because it's been a real disaster for them, at least the headline. But if they were to sell that bank, they would probably go out to Capital One. If I can find it. I can never remember their COF. Go out to Capital One and look at their price to book. Right about 1, which means they would just take the net worth of the bank, and that's probably what they could sell it for. They could probably sell their bank for about the value the accountants say it's worth, somewhere around 1, because Capital One's probably the most similar to USA's bank there. What about Frost? What do you think they're trading at? Good Texas company, you think they're expensive? Might be surprised as how expensive they are. Look at their price to book. They're like a JP Morgan. Did y'all know Frost was as valuable was highly valued as JP Morgan? Why is Frost, anybody know why Frost is so valuable? So when we do this class next time, I'm going to want a lot of input from you because next year we're going to have it as 2 semesters. We're going to do banks the second semester. There's one ratio Frost really shines at. Anybody know?
Like a tier 1 capital ratio?
Their ratios are good, but that's not the thing that people love. So it's something called loan to deposit ratio. They have a very low loan to deposit ratio, which means they got a lot of capacity to lend out. A bank like Goldman Sachs would love to buy them to get all their deposits. They would just love it. We like Frost. Their brokerage service is horrible, but Frost does a pretty good job on other things. But yeah, Frost is an expensive company. So if USA were to sell their bank, maybe they would get higher than the 1 because they may be higher quality than Capital One, but they've had such bad headline risk this last couple of years that maybe not. But price to book is what they would use. When USA sold its investment arm to Victory Capital, I'm sure they used price to assets under management, or probably enterprise value to assets under management, kind of a similar type of thing. So these industries, return on invested capital is the most important thing they do. And in revenue base, all of you that are doing retail, this one's the most obvious one of all. You're doing anything that's retail, that's EV to sales. That's what we use. I don't know if you remember when we ran your model, you know, I had an EV to EBITDA in there, but I knew it was going to allocate anything to it. It's going to put 100% on EV to sales. It's just the most obvious place to put it. So anybody have a question on your industry where you might go with your ratio? I remember all of your firms. Jonathan, Coco, what does that sound like? Where would you put yours?
Price to book.
Price to book, really?
How much?
I haven't looked at them. I thought they were more revenue based, but
It is the model like for the price to book.
I can't remember on your model. I have to go back and look. For me, Coca-Cola, Pepsi, I would do EV to sales, but I mean, it's possible. And look at their property, plant, and equipment as percentage of assets. And if it's below 40%, you're probably not going to use price to book. Can't remember your other companies. So apparel, those are doing apparel like Ross, definitely EV to sales. Chemical companies, maybe price to book, but you have to kind of look and see. All right, so pick one. If you want to try a peg or price to 10 years earnings, I'll try to experiment maybe some tomorrow and see if I can get that into the model. Thursday night, we're going to talk about the model and see what you got to do with it. So we really got just two more things to do that aren't in the video, and that's the capital IQ model and this relative value approach. And then we got paper 5. I'll finish up this presentation next time. All right, I'll stop it there. All right, let's finish up relatives, and then we'll do a little bit of testing tonight to see if you understand this, because this is something students struggle with for some reason. So the most common relatives they have, remember, you want to match up the numerator and denominator very, very carefully. The ones you're going to see are earnings base, which is price to earnings. So price is stockholders, earnings per share is stockholders because it's after interest expense. EV, the EBIT, enterprise value, the EBIT, that's before interest. So you need stockholders and bondholders, Same thing with EV, the EBITDA before interest expense. The PEG ratio is just the PE ratio divided by G. There's book value based relatives, price to book value, our price to multiple year earnings per share. That's a good substitute. So, so Miranda, you're doing Starbucks, or is that who's doing this behind you?
Beverly.
Beverly. Okay, Beverly. So if you have a firm that has negative net worth, Bloomberg does have a price to multiple year earnings per share. So I tested it today and it's wonderful. It works, but it doesn't work for the industry or the stock market. So you can't compare it to anything. You just have it, but you can get it. So if you want to pull it in for your company, you can get it and see where they are. But they do have that ratio. It's pretty cool. I don't know why they can't do it for the indices and the sectors, but they can do it. And then EV the sales, which is a nice one because you avoid negative numbers entirely, which is kind of nice. EV the sales, there's revenue based relatives. So earnings based are for technology companies. Those are really focused on growth. So if you're doing technology company, you're probably going to do more than likely EV the EBITDA. That's going to be the most popular. All right. Price to earnings works for everybody. We use it for all sectors, but EV to EBITDA for technology companies. For book value based relatives, well, I'll come back to that one. Revenue based, very straightforward. Any firm where you're focused on margin, especially retail, you're going to do the revenue based. And then book value based, high capital requirements, cyclical stocks, commodity based companies, and financials. So high capital requirements. Again, the way you can tell that, go into Yahoo Finance. So let's look at one like Duke. Duke is one of those companies. Go into financials. So this is why you could test your company. Just go on the financials, click on balance sheet, click on total assets and non-card. You just look at the net PP&E compared to total assets, and it's massive, 116 billion versus 176. When you see a firm with that heavy property, plant, equipment, they're probably going to use price to book. The same thing works for Intel. Intel has a really high property, plant, and equipment. It's over a third of their assets is property, plant, and equipment because they build those big fabrication plants. Now you might say Intel, that's technology. They should be using EV to EBITDA, but you could conceivably use price to book value for Intel. You look at a firm like NVIDIA, their property, plant, equipment is less than 10% of their assets. Anytime you have a firm where their property, plant, equipment is less than, say, 25% of their assets, you're not going to use price to book. So the key on price to book, and just think about it, is how much of their business is actually on their balance sheet. NVIDIA's assets really aren't all that key to their business. NVIDIA's most important asset is their employees. It's not anywhere on the balance sheet. So if their business is not on the balance sheet, you're not going to use price to book. All right. So you can look at that real quickly and just see if price to book makes any sense for your company. The second group are the commodity base, the cyclical companies, energy, materials, anyone that's really sensitive to commodity prices. That's where price to book or even price to 10 years earnings is really powerful and gives you a good sense of the company. If you don't do that, energy companies look really cheap at the end of a year like 2022 when oil prices have zoomed up. They look cheap. Why? Because the earnings soar, but the stock market doesn't soar because the stock market knows commodity price can be volatile. So this price is there and the earnings have soared up, so the PE drops down. And a year like 2020, when oil prices fall, the stocks look really expensive because the earnings fall because oil prices have fallen, but prices don't fall as much. But stockholders know it's going to be like that. So if you use price to book or price to 10 years of earnings, you spread all that cyclicality out of there. And then the last group are industries focused on return on invested capital, banks, insurance companies. There, you're just going to use price to book. And we looked at it last class. You can kind of just tell on price to book. Let's look at NVIDIA. You do statistics. Their price to book is 54. It's a nonsensical number. You're paying 54 times more than what the accountants think the company's worth. Remember, book value is what the accountants say the company's worth. That doesn't make any sense. But then you look at a bank like JP Morgan, and you get a price to book around 2. So if price to book makes sense, the price to book itself will make sense. It'd be somewhere, it won't be 54 or 100 or something like that. Now, there are some exceptions. Let's take Tesla. Tesla, heavy manufacturing, large property, plant, equipment. Auto firms usually use price to book. What about Tesla? You bring up Tesla, their price to book is 15. Doesn't make a lot of sense, but Tesla is an unusual company. So it's either extremely expensive or there's something else going on there. So there are a few exceptions. Price to book would probably make sense for Tesla, but boy, they're going to stick out. Now their PE ratio sticks out as well, as of their EV, the revenue, everything for Tesla looks expensive. So the market's obviously expecting massive growth for this firm. So usually if price to book makes sense, the price to book itself will be a reasonable looking number. It won't be 15 or 20 or 30. It's going to be 1.5, 2, 2.5, something like that. It won't be that crazy number. All right. So let's test it. I'm going to test you. If anyone gets all these right, I'll pay him $10,000. Let's start changing my mind later. So what I want you to write is a G or a B. Good or bad, right? You don't have to write down. You can just write 1, 2, 3, 4, 5. So we'll start with this first one, price, earnings.
So
Are you saying like this is the price, but this is like $40 per share and this is like $40 billion or something?
Yeah, it's in, wouldn't it be EV, isn't EV to earnings a very measure?
Well, earnings, you assume this is net of interest. It's net of interest expense to use price or EV.
Oh, then you,
Yeah, so it's gonna be good. Now, if you're thinking this is the stock price and this is the actual GAAP earnings, well, yeah, that would be wrong. You don't do price over net income. But we use the word, you hear PE ratios, right? So PE ratio is technically price to earnings per share. But we often hear it as price to earnings. It's a good ratio, but they really mean price to earnings per share. So it's good if earnings is EPS. If earnings is net income, then yeah, if it's in billions of dollars or whatever, that doesn't make sense. But
Would it be interchangeable then?
we say price to earnings when we mean price to EPS. So it is interchangeable when we use it. I don't know anyone that says price to EPS ratio. They say price to earnings ratio. So we just got in the habit of saying that, but we really should price to earnings per share. What about price to sales? Is that good or bad? Bad. So price is the stockholders, but sales is before interest expense. So you can't do that one. That's the one that is on Yahoo Finance. So that's the one place Yahoo Finance makes some mistakes. What about EV to EBIT? Good, yeah. Anytime you see before interest, you have to use enterprise value. What about EV to book value? That one's bad, right? Book value belongs to whom? Only stockholders. So you don't want everything on top. Price to EBITDA. That one's good or bad? Why EBITDA is before interest expense? You should have EV. Price to book. That one works. Use it quite a bit. EV to revenue. Good. What about EV to sales? It's the same thing. Okay. Why does Yahoo Finance do that? It's kind of interesting to me. They do price to sales, that's wrong, and then do enterprise value to revenue, which is right, but I don't know why they switch from sales to revenue, as if those are two different numbers. It's the same thing, but this one's incorrect. This one is correct. And PEG ratio, it's perfectly fine. Yeah, there's no problem with the PEG ratio. We're still running our model for the investment society, and we're still making a lot of money. I wish I had done that transaction. We'd be up 800,000% in just 4 weeks because it's actually working well. It's a PEG ratio model, purely probably random chance that it's doing so well, but it's doing really, really well. All right, let's try. Give me the correct ratio. So as a finance professional, when you hear a company, you should have a pretty good idea which ratio you should use. And if you're not there yet, just start practicing and practicing. There's a couple on this chart that are a little bit questionable, but most are pretty straightforward. So let's see what y'all thought. Meta, what would you use? EV to EBITDA, yeah. It's pretty straightforward for a Meta. Hop,
Hey, boy, one price to book.
price to book, yeah. Energy companies, oil companies almost always use price to book. Costco, EV to rev or sales. Yeah, any retail, what about Kroger's then?
Same thing.
Yeah, EV to revenue. Starbucks,
I thought it was the same thing.
same thing, yeah. So, yeah, any retail company, I mean, it's just EV to revenue. It just dominates. One of y'all's models at the beginning of this year was, I forget which one, consumer discretionary, maybe, I can't remember which team, but it for some reason allocated the price to book. And so I went home and actually fixed the model so it did the price to book, and it didn't change it much. So didn't matter, but it did 100% price to book. I did 100% price EV to sales. It slightly changed the model, but not much. But that really bothered me. It just does not make sense to use price to book for retail. What about US Steel? Price to book. We can look at them. I don't know that much about US Steel right now. But again, a quick check is just to go to their financials, go to their balance sheet, click on assets, click on non-current assets, and About half of their assets are property, plant, and equipment. So that kind of, confirms price to book is a good place to be. I don't know where that music's coming from. Is there a concert downstairs or something? Okay, JP Morgan. Price to book, yeah, banks are easy. What about a REIT?
I thought it was the same thing, but.
Price to book, yeah. So go back to what I was saying before. What's on the balance sheet of a real estate company? It's a bunch of real estate. Is that related to how they make money? Yeah, that is their business. So when you can see the business on the balance, you go to NVIDIA's balance sheet, you don't see their business, do you? There's nothing on their balance sheet that says, oh, this is what NVIDIA does. You go to a REIT's balance sheet and yeah, that's exactly what they do. You go to a bank's balance sheet, yeah, that's what they do. They auto loans, they have deposits. It's very straightforward. So those businesses where you know exactly what the business is doing by looking at their balance sheet, price to book, it makes a lot of sense. What about Ford?
Sales.
Yeah, here you can do EV, the rev, R price to book. Yeah, everybody loves that echoing part down there. So we just get the little music. They sound really good. It's a good choir, but we're not singing finance songs. All right, so Ford is a little bit retail lead because they sell to the general public, but I would probably lean here. First of all, we can look at their property, plant, and equipment. It's probably fairly large. It's not as massive as some of the others. One of the reasons it's not so massive really has to do with, they got a lot of inventory and receivables, so that kind of throws it off. But what's the other thing that we have a challenge with Ford? So property, plant, and equipment and Ford Motor Credit. It's also a bank. In fact, it may be more of a bank than it is an auto manufacturer. And so that's part of the challenge here with Ford and GM and some of these others. I don't know about Tesla. I'm not really sure how Tesla does. Anyone bought a Tesla? Do they finance their own cars? I may know.
I think they do.
Is it a big part of their business? Is there a Tesla Motor Credit?
Not sure.
So I don't know. I will never buy a Tesla because they'll just assume I'm going through midlife crisis or something. But so I would probably lean toward price to book because there's really two things there. They do have fairly large property, plant, and equipment. It's not as massive as some of the others, but they are somewhat of a bank, so I might land there. What about Lowe's? This one's pretty easy.
Okay.
Even the Rev, yeah. I'm using Rev because it's easier to type. All right, here's the challenging one. Disney. I could go EV to EBITDA or what might be another one.
Revenue.
EV to Rev. So they're under communication services. So they're in the same area as Meta and Google and all of those. They're not exactly a tech company, but they're becoming more of a tech company. They own ESPN, which is very techy. They also own theme parks and cruise lines. Those might be heavy property, plant, and equipment. So price to book could maybe even go in there. How can we tell if price to book makes sense? Any suggestions on that? We maybe look up their balance sheet. Market really liked their last financial report, didn't it? Finally some good news. It's not huge. It's not a huge part of their, but yeah, let me show you a company that is really bizarre. See if this stands out to you. This is AT&T. Anything stand out on AT&T on their balance sheet? So like one number that stands out above all the others. Goodwill. It's half of their assets. Other tangible assets. What in the world is that? So I would use price to book for an AT&T. Their property, plant, equipment is a good chunk of their assets, but goodwill, a lot of that is purchasing other firms. That's why their goodwill is so high. Other tangible assets, that might be all the bandwidth that they own or whatever, that's a huge cost because the government charges quite a bit for that. But that causes problems when you have a massive number like that sitting there. But good chance, you look at this, price to book makes a lot of sense for a firm like AT&T. So Disney, did we ever actually look at their price? They have quite a bit of property, plant, equipment, but this is one. They come in with the media companies. Media companies are probably going to use EV to EBITDA, so they're kind of in that category. But Disney is a tough company. It's a little bit of a conglomerate. They're in so many different businesses. It makes them a little tough. The theme parks and the cruise lines, you could use EV to EBITDA, but I mean EV to revenue, but you'd probably use price to book. What about MetLife? Price to book, it's a financial. Insurance companies, banks, real estate companies, you always use price to book. I will say for REITs, there is one other choice, and that is EV to FFO. So I'll let you look that up your own. From funds from operations is a really popular one for REITs, so that's kind of a special case for them. What about Duke?
Price to book.
Price to book, we just looked at them. Apple, EBITDA. Aerospace, price to book. We can look at the financials. I always want to double check. Some firms can really fool you. But yeah, overhast their assets. No, they don't. They have a lot of goodwill as well. So with goodwill, so what does goodwill recognize? So a lot of people say goodwill is brand. They bought another company for much more than its book value, and that's just like the value of that brand.
Premium, right?
Yeah, it's a premium. So the GAAP accounting was 5 billion, but they bought the company for 25 billion. So they put 20 billion of goodwill on there. Goodwill is a tough one. I don't know what all General Dynamics has been buying here recently. So that one's a tough one. I kind of would think of goodwill and put it with property, plant, and equipment, but it doesn't always work that way. But so that one's a little questionable. Their net price, their property, plant, equipment is not as large as you would think. If you think about a Boeing, you would think Boeing have a lot of property, plant, and equipment, but they have spun off so many subsidiaries that they outsource a lot of their manufacturing. It's possible General Dynamics does that, but they don't actually own the manufacturing. They source it out to subsidiaries. General Motors the same way. General Motors has spun off a lot of subsidiaries. So the people who make their mirrors, the people who make the seats, the motors, all this stuff gets sorted. I don't know, Boeing hardly is, what does Boeing actually even make anymore? They spun off so many of their companies, and the companies they spun off are all struggling as well. So, there's a company called Spirit, not Spirit Air, but Spirit Aerospace. That's a spinoff from Boeing. And I don't know how it's been doing, but probably not particularly well, not well in 2020. But just, these stocks are really struggling. It's only a $4 billion company. So always check and see. So General Dynamics, I don't know what you would do with General Dynamics if you don't do price to book. There aren't any obvious other choices to make for a firm like that. What about Eli Lilly? That one's a little tough. So pharmaceuticals, they're not really financials. So if you do price to book, your challenge here is research and development is not on the balance sheet. So the most important thing they do is not on the balance sheet. So it's hard to say price to book. So let's look at their balance sheet and just see. So it really is, when you're looking at a firm for price to book, you're really asking how much of the business is obvious on their balance sheet. Now look at the assets. That's really the most important thing. They do have some significant property, plant, equipment. They have a huge current assets. So it's, huge receivables. No telling where that's coming from. So it's hard to say on a firm like this. Remember, the other thing we say we can do is look at statistics and see if the price book even looks reasonable.
Oh,
What would you say now?
no.
Probably not. It's a little skewed. So that one's a little tough. If you're not sure, if you're not really sure, go back to an earnings related. So go back to EV EBITDA. So anytime you're like, I have no idea. EV to EBITDA, price to earnings, EV to EBITDA are always safe ones. You can use them for just about anyone. So that's the safe bet. Now remember on your first project, I'm sorry,
Why did you say we use the media revenue for retail as well?
anyone focused on margin, use EV to revenue. It's just all retail stocks. You're gonna have to now. When you get into confusion, is a firm like a Carnival Cruise Line, that's kind of retail, but massive ships. So I'll probably go with price to book. So it's hard to look at a Walmart or someone look at the balance sheet. You see the stores are in there, so yeah, that's kind of on the balance sheet. And you have the inventories, but margins is so critical. EV to the revenue makes sense. All right, so kind of get some practice as you figure out your company. There are times where it's definitely questionable. That's the advantage of doing the model we did, is you like Excel tell you what the market thinks, and that's sometimes that can be surprising. Like we saw with the consumer stocks, them picking price to book. I've seen with technology stocks quite frequently, it will pick EV to revenue on tech stocks for some reason. So you can let that be the driving force. I will say if you're doing retail and it picks price to book, you might force the model to pick price. EV to revenue, and just see if it messes up in your model. If you're really close, I would go to EV to revenue and not use price to book. So force the model to do 100% because it just makes a lot more sense. I can't imagine ever doing a bank with anything other than price to book. It just would be really bizarre. So what can you do? Well, what you did on project one, hopefully you remember how to do that and you built your own model yourself. I've never done this, but you could conceivably do this with bonds as well. If you brought in all the financials on bonds and got their CDS spreads, you could try to figure out which bonds are overpriced or underpriced.
Like for JP Morgan, if you try to do like EV to EBITDA, how would that work?
It can work. It works. They have a price to earnings. You can do that. Where you get challenged with banks is when you start looking at things like free cash flow, cash from operations. Banks and insurance companies, cash from operations is a really deceptive number because the cash is a lot of that's really borrowed money because if you sell CDs and GAAP accounting has changed that somewhat where a life insurance company sells a big annuity that may actually go under financing and not CFO, but it can get really confusing because a lot of the cash is really not cash, it's really borrowed money. It belongs to the customers, so it can get pretty tricky. All right, so you could screen on bonds. Y'all know what CDS is? Credit default swaps, those spreads. So you could try to use liquidity, solvency, turnover margin to try to forecast the CDS spread and compare the two. I've never tried it, so I don't know how well that would work. The problem with bonds, though, is a firm like Walmart might have 40 bonds. So you can't just do Walmart. You have to do all the bonds. So you may find some of Walmart's bonds are overpriced, some of them are underbought price. Plus, bonds aren't traded all that frequently, so you can't always trust the numbers. You can use it to value non-publicly traded companies. So when USAA sold off its investment arm, it probably looked at BlackRock and some of these other public firms, look at their EV to assets under management and apply that to their firm, their business. And then when they sold to Victory Capital, I actually did that analysis. I felt like USA got underpaid for their business. It looked like Victory Capital got a pretty good deal on that. But I looked at it at enterprise value over assets under management because that's how they make their money, is assets under management. You can use it for determining benchmarks for your firms. So whether they're public or private, you run the model and say, hey, wow, we rank 52nd on this margin analysis. We need to get our margins to a higher level. That's the reason our stock is so cheap. Of all the factors we look at, margins the one that's bringing our stock price down the most. We got to get that strengthened. And then as we saw in project one, what's the most important factors that the market's looking at? You might disagree with that, You want to change the weights, but you let the weights run so you can see what is the market focused in on. You look at the R squared as well, the R squared's, 40%, then you're missing something. The R squared is 80%, then you've got the major factors. What is the market focused in on? Right? So there are two approaches. We did the ranking model approach. That's a far better approach, I think, in my opinion. I was tempted to take one of our models we built. Maybe I'll do it before one of these classes and do a regression on it. Regression models, it works. Excel can handle it. It can handle multiple factors. You have multiple independent factors. The problem is when you get the output, there's going to be something that's wrong. One of your slopes is going to be wrong, and you'll have to throw the entire model out. You can't use a model that tells you firms with more debt are more valuable than firms with less debt. That just doesn't make sense. Our firms with low margins are more valuable than firms with high margins. So if you get a negative slope on some of these things, or a negative slope on margin or positive slope on debt, you have to throw the entire model out. It doesn't logically make sense. And that happens a lot with regression models. The Motorin does regression in his class, and I think he cheats. Not that I want this on film, but I think he picked one industry that worked really, really well. Everything lined up. All the statistics were good. So you ran that and you go, wow, that really works well. Let's do that. And you try it 80 times. We used to do this in the investment society. We'd have one factor didn't work. So we say, well, let's just kick that out and rerun the model. You rerun the model, and then another factor goes out. And you take that one out and you end up with nothing at the end. It just doesn't, the statistics is pretty rough. What the ranking model does is, remember, we're allocating weights. And if asset turnover is going in the wrong direction, the model was telling us lower asset turnover means higher valuation. The model just assigned 0% of that and just kicked it out. So that's the advantage of the ranking model over a regression model. But you could do both. So you've seen the examples because you did at the beginning of this class. I'd still strongly recommend you make sure you can build one of those models from scratch. Watching our videos. I know some of y'all have done it in the investment society. You get some good practice on using Bloomberg. I have not built one of these models using entirely Capital IQ, but I'll try to figure that out. Capital IQ has all the data as far as the fundamentals, turnovers, margins, and all of that. What I'm not really sure at is how you get numbers in on PE ratios and EV to revenue. Have any of y'all tried that with Capital IQ? I mean, it might do it okay and do a fine job with it. I just haven't tried Capital IQ. For this class, next time I teach it, if you're in graduate school, you could take it all again. You have to do a different company. I'd force you to take it to another company. But it's going to be 2 semesters. The second semester is going to be somewhat different. But it looks like to limit the class to 20, 25 students, that we might be able to fit it in the FSC and do the whole class in the FSC, which would be wonderful. So if we do that, if it's 25 students, there will be 16 Bloombergs. So there wouldn't be that much sharing. 2 people would share and wouldn't be all that bad. So that would be pretty good. We really need to do that because we need Bloomberg in the room. I've tried getting Capital IQ in the room, and I just cannot get Capital IQ to work on my laptop when I need it to. And it's just pretty unreliable. Now, someone here emailed S&P, didn't you? Is that Hiram or Diego or someone?
Diego emailed.
They actually fixed it for you?
Yeah, they sent me a link and I just accessed it.
Okay, you might email. My Capital IQ works perfectly well at home, but when I put it on my laptop, it's really strange. It's a very unreliable database. But anyway, so we need more of that in the class so we can do those kind of testing. All right. So let's put this together for your project. All right. So I'm going to show you Walmart. I've fixed this file. It's out there on Canvas. You go down to the bottom. It's the very, very last file, relative value history. I fixed it. I've been working with it. I'm going to show you that. So take really good notes here. Maybe make a point that when you get to this part of paper 5, that whatever minute we are in the class, like 30 minutes into the class, that you're going to really need this file so you know how to work it. I'm not going to make a separate video for this. So you loaded the file in Bloomberg. So this would be a great place if I had Bloomberg actually working. You'll put your ticker in here. And when you run it, you can change the date to whatever start date you want. I'd recommend you give it a start date at least 30 years. When you do that, you'll probably get a lot of NAs. So just page down and see where the NAs stop. So maybe it stops there, maybe it stops here, okay? And so if your NA stop there, then just copy that date and put it as your start date, right? And then that'll get you all the data you need. One thing you'll notice is the NAs won't be consistent all across, and especially on EV to EBITDA, you'll probably have a lot of NAs here. And a really irritating thing I've discovered is you come down here and the NAs stop right here on all of them. So you pick this date, you paste it up here, and then it still has NAs there. I don't know why. And you notice there is some question with EV to EBITDA that the NAs, I mean, that the numbers don't even change for a while. So it's almost like they had quarterly numbers or something. So there is some strange things with EV to EBITDA. It will give you strange graphs, and you'll see that when we do the graphing. It does give you some strange graphs. All right, so that's step one. Someone write this out in the steps. Step one, get your ticker right. You just change the ticker to the first few letters. All right, you have to have that US equity in there, but you put your ticker in there. Okay, that's step one. Someone keep track of steps and then email them to me afterwards. So like someone do a favor for me. Anyone gonna volunteer for that?
Okay.
All right, Carlos, all right, thanks. Number two, pick your date, take an early date, figure out where the NAs start, and then change your date so that you don't have those NAs. The ending date's blank because it's just gonna go to the current, okay? Step two, y'all got that? Y'all let me know when you're ready.
Okay.
All right, step three over here in G5, you want to pick your industry. Now, if you don't know what your industry is, so it's consumer staples, energy, financials, healthcare, industrials, tech, materials, and real estate. This tells, I don't know, someone here is doing Google, right? You're doing Google, okay. That tells is really communication services. So they used to be telecommunication, now it's communication service. So Google is in tells. And then you got utilities, all right? So you pick your industry. If you're not sure, there is a sectors tab that gives you the actual titles, all right? So change this to your industry. So there's that four things, right? Ticker, or three things: ticker, date, and industry, all right? When you do that, you'll get all your data in. So step four, are we up to four steps, Carlos?
I have four.
You already have four, all right. I can't remember what, maybe step three was to get rid of the NAs, but all right, the next step, whatever next step is, copy all of this to the next page and A1, right click and paste it as values. Paste it as that 1, 2, 3. So you have all that data in here.
You can copy everything.
Yeah, click on the triangle and you control copy. I can't do it here or mess it up. And then paste it as, I'll do a little bit of it. So copy this entire page and over here, paste it and use that 1, 2, 3. So this page is exactly like the first page, except it's pasted values, so you can use it on a machine outside of Bloomberg. That's step 5, right?
Yeah,
Carlos?
fine.
Step 6 is save it under a different name so you know it's your company. So this is a good point to save it. You got all the data. That way, if the electricity goes out or they close the FSC, at least you got your data. And I would save it. I would probably say save it and email it to yourself so you have it. All right. Do that as early as possible so you don't get locked out, because you can do the rest of this from home. So save it, email it to yourself so you have the file. Because you'll have to be on a UTSA machine because it's Bloomberg. Right. Then go to step 7, go to the output. Now, on the output in row A, just, you might control down to go down to the bottom. What you're gonna discover when you go down to the bottom is you may have a bunch of blank cells. Let me just give you an example with Walmart. So if you started yours later than mine, I have 2491. If you started later than that, when you go down the bottom, you have a lot of blank cells. It's because there's a formula in there that says, hey, if there's nothing down on the page, just give me a blank cell. Well, let me just tell you, you're going to want to get rid of that blank cell. So come down here. Now, so there's two things here. This may be 7-8. Make sure your last shown date is the current date. All right. I did this today. It says 11/21. If it doesn't show that, then you need to take that entire row and copy it down until you get that date. All right. Carlos, that's a lot to type. Y'all see what I'm saying there? You'll probably be okay, but if your starting date is before my starting date, you'll actually need to add some lines here at the bottom.
I have to make sure it's the current date, the
Whenever you're running it, yeah.
And then we don't, for example, the day we're running it, we don't have to keep changing it. We could just leave it on that date, correct? So for example, let's just say today's the 21st and then.
Well, that's why the ending value is blank. It's always going to go to today.
Okay.
That's all. That's the way it's set up. But this file assumes, you stop whatever your last row is, whatever this last row is. Assumes your last row is 8925, but your 8925 might be October 10th, not November 21st.
Maybe just keep that. Okay.
But, okay, Carlos, so this might be the next step. Once you have that there, once you find that last date, if you have data below that, you have formulas below that, remember there's nothing, looks like there's nothing there. I would control shift down and right all the way across and hit delete. You don't want stuff below this. You're going to see why, because you're going to do some graphs. If you have all those extra lines, when you do control down, you're going to have way too many lines. So you can get really irritated. So you want to make sure you go down to the current date and you want to make sure there's no formulas below. You might go, here to be simple, make sure it goes to the current date, go to the next line, and whether there's a formula there or not, just do control down, control right, hit delete, and just make sure there's nothing there. All right. And you'll see why when we do the graphics, because it really is very irritating when it goes down too far. All right. I don't know, that you will be up to step 27 now. There's a lot in there. Right. So what are you going to do with this data? So now you got to pick which ratio you're going to use. So let me just tell you what I have here. I have PE ratio, EV to sales, price to book, and EV to EBITDA. EV to EBITDA is a little challenged the way Bloomberg does it, but we'll see. I'll show you Walmart, or I may show you NVIDIA. I tried the PEG ratio. I could get it from my company, but I couldn't get it for the industries. I tried price to 10 years of earnings. I could not get it for the industries. So I gave up on those two. But if you want to run them just for your company, you could do that, get the data over there. But I just could not get those to work for the sector in the company. So you have your output now. So there's a few things you can look at. So let me, for Walmart, I'm going to do EV to sales. So I want to bring over the data here so I can look at it. So this steps may not work anymore, Carlos. You may have to give up on the steps. So my EV to sales, I'm going to bring it over here so I can just look at it. I might just have to watch the video for this part. And you could leave it on that page, but just to make it a little bit more workable. And then I'm going to do the percentiles. You already have the median, so I'm going to do maybe the 20th percentile and 80th percentile. So I'm going to do equal percentile versus the industry. You can see why the control down is so important. Right there, comma. the 0.2. You want to lock these in on the rows. Lock this in. You don't need that sheet. Lock this in on the column. So there's the 20th percentile. Oh, and the 80th percentile of yeah, I'm gonna have to move this. Sorry, I messed up. Put it over here. All right. I forgot I went sideways. So I have that range. I want now on E2. There's the 20th percentile and the 80th percentile. So pretty tight range, right? The median's 0.5, the current's 0.64. You want to change it to 0.1 and 0.9 to get a wider range, you can certainly do that. But all right, so there's that. And then I want to do the same thing for this next one. So I'm going to copy it down. And for the market, market is column H for me. So I'll do column H. There's their 20 percentile, there's their 80 percentile. Oh, I needed to lock in G. Oh, wait. I'll explain this again once we get into it. So that makes a little more sense, actually. Threw myself off by going sideways instead of down. All right, so here we're looking at column G because I'm doing EV the cells. I've got the column locked in. I should have the rows locked in as well, but that's okay. I have the column locked in, 8 through 8226. Let's make sure that's correct. 8226. 82, 86. We got our 20 percentile, our 80 percentile, 82, 26, 226. So there's my 20th percentile, my 80th percentile. And then I'm going to bring in their current EV cells. Bring that in. Their current EV the cells is 1.147. So that implies they should be somewhere between right. Yeah, I did something wrong. But essentially what I want to do is get a good range here. So currently they're at 0.64. I'm sorry, currently they're at 1.14, but they're 42 or 27% expensive to their industry. And so that implies that 1.14 should be 0.74. And if you look at so you have the lower band and the upper band. So the 1.14, they could be as high as 0.73, currently at 0.64. So they could be that times 73 divided by 0.64. So they could be between 0.74 and 1.3. That could be a reasonable EV that does revenue for them. Right, that's somewhat their range. Same thing versus the market. It could be as low as 0.28. They're currently 0.64. So their EV to sales could be 0.94, or it could be as high as 1.73 if I did that correctly. 0.52 versus 0.32. So that's their range. So what you need to get is looking at what their historical range has been versus where they are today. You want to get a sense of how wide this range could be for Walmart. And then you're going to apply this to your capital IQ Excel file. Right, so let me walk through this again because it's a lot in a spreadsheet. I'm not going to have this set up on the spreadsheet for you, so you have to set this up yourself. I'm doing it on a separate page. All right, so you got the median for their entire period. They're currently at 0.64, so they're a little expensive. Historically, 80% or 60% of the time, they've ranged between 0.42 and 0.73. They're at 6.4. So just be real careful. What these numbers are is this is their EV to sales divided by the EV to sales of the industry and S&P. All right, that's what that is. So they have historically traded 50% cheap to the industry, 64% cheap to the S&P 500. Right now, they're 36% cheap to the industry, but 66% cheap to the S&P. Why is that? Why are they expensive to their industry but cheap to the S&P? Well, because the S&P is dominated by those growth stocks. So everybody except for the growth stocks looks cheap. They're expensive to their industry but cheap to the S&P. If I were you, I would probably use the industry numbers. If I were you, I wouldn't use the S&P, but you have it there if you need it. All right. The historical range is 60% of the time. They've been 58% to 37% cheap to the industry. Today, they're 36%. So they're in that range. They're up closer to the upper end than the bottom end because you can tell with the median. So their actual EV to sales is 1.14. So what that implies is their EV and you can do the median as well if you like. You can take the 1.14 times the median divided by the current and say they currently should be 0.9. So they've ranged between 0.74 and 1.3. No, not 0.9. Yeah, 0.9. So don't get confused. This is the EV to sales. These are EV to sales. All right. I know it gets confusing. This is the relative to the industry. This is the actual EV to sales. All right. I'll do in video as well so you can get some practice with this. All right. So you can say Walmart has historically traded 50% cheap to its industry. Today, it's only 36% cheap to its industry, so it's trading 27% rich to its history. Walmart historically has traded at a 50% discount to its industry. But today, that discount is only 36%. As such, Walmart is trading 27% rich to its history. All right. Any questions on that? Does that make sense? Y'all see where I got all those numbers? So someone implies that they're overpriced, but then the question is, how overpriced are they? Are they outside of the 60% range? Are they at a 90%, 95%? How rich are they? So that's the next part we can say. So this next part, everybody got all that? Some of y'all taking pictures, this is fine. All right, so the next part is today, Walmart's EV to sales is 1.14. Based on history, that ratio should be 0.9 within a range of 0.74, 1.3. Everybody understand that? Here we're talking about the actual EV to sales. The current EV to sales is 1.14, but based on the 80% range. So this is their 80% range of the relative to each other. So the ranges, they were 58% to 27% cheap. The industry, based on that, their actual EV, the revenue should be between 0.74 and 1.3. And the median should be 0.9. Right now, they're trading at 1.14. Right? They look a little bit rich. In fact, this should give us, if I did it right, we'll see. Should give us that 27%, right? They're at 1.14, they should be 0.9, so they're trading 27% rich through their industry. Okay. The reason I'm sticking with the industry is it makes more sense. Plus, this gets really confusing if you do both the S&P and the industry. So I would stick with the industry number. Questions on that? It's pretty complicated unless you kind of get it set up correctly. You might type these type of words out into the Excels so that you're really clear what you're talking about. So what does that mean in the capital IQ file? Remember, in the capital IQ file, it's doing free cash flow for 5 years. And then at the end of 5 years, it's taking a relative and applying it to give you the value at the end of 5 years. So what would you do here? At year 5, you would take revenue times 0.9. That equals the value Walmart at year 5. So what that capital IQ model is doing right now is it's taking an EBITDA relative and it's multiplying that by ending EBITDA. But if I'm doing EV the revenue, I need to take that and apply it to final revenue. So I need to change the formulas there. Okay. And you're going to run 2 scenarios. You're going to do this times 0.74. You're going to do it times, what's the other number? 1.3. And this is going to give you your football chart for cap IQ cell model. All right, you're going to have your medium value and you're going to have your 2 extremes. All right. Relative value is really focused on how things do historically versus each other. There may be perfectly good reasons why Walmart looks more expensive today, but you want to somewhat put it in context of its history. I don't know if I have time for me to do NVIDIA. Do y'all want me to try NVIDIA and do this whole thing again? Can y'all handle it? Yes, he says yes. Are y'all with me? Randy, you want me to do it?
For semiconductor, which ticker would it fall under? Information tech?
Tech, yeah, information tech. Yeah. I do have the tickers now of I actually went through a lot of work to do this, but I got it to work. So it's possible if you want to get a little more precise. I do have 25 industry. It's the whole thing's going to give me error messages, but I do have 25 industries, and I think semiconductors might be one in here. I'm not real sure though. Now I can't tell the name because it went away, but that's 25. So I do have these. If anyone wants this file, I want to get more precise and just do semiconductors. I think the issue you're gonna have, Brandy, is it may not have as much history as information tech does, but it might. I'm not sure how let me see if I load this again, maybe it will not do that. I won't. No, it's gonna do it. Well, let's see. Yeah, it's already gone. That's auto, that's banks. So they have banks instead of just financials. They have a lot of consumers. Broken up. It might be this one with the S in it. SSEQX could be it, but I'm not real sure. They have software, they have tech, they have telecoms, transportation, utilities. So they do have more. So it is possible to get more precise, but not required. If I were doing a bank or an insurance company, I would definitely just do banks. That would make more sense. You can't do that with the file I gave you because it only has the 11 sectors. All right, let me show you in video. I might not do the entire thing on video, but what's the first thing I would do here?
Put 30 years back at least.
All right, so change the ticker. It's already there. Go back, however far back, you'll get NAs. You see I have NAs here on EBITDA, but it does start at one point. All right, make sure you change the index here. Now, if you wanted to use one of the other indexes, it really doesn't matter. You could just type it into that box. So maybe I'll get you a list of those other indices and put it out there for you so you can look and see if you want it. And we could just test it. I may test it and see if it actually would bring in more data. All right, then you copy and paste that entire thing over here. So you have it in there. Then on your output, go down to the bottom. I've already erased it, but make sure you don't have anything. So just gun down the bottom. I got 1121. Go ahead and just delete everything else below that. So I got all my data. And then you want to collect that data here. I'm going to look at EBITDA. And you notice it's missing at first, but you also notice the numbers, it just doesn't look right. It's a little much, it's not as bouncy, it's a little square. I mean, it works okay, but it's a little boxier than say using a price to earnings. So on tech stocks, you might, if you get a really squirrely EBITDA, you might do the PE ratio instead. Because it's going to be much, it just depends. Look at the graph and see. That graph I just showed you on EBITDA wasn't bad. But you notice it looks very different than this, right? It's much boxier because it doesn't number some changes much. So you have to be careful of EBITDA because if earnings is negative, you have a bunch of missing numbers. Or if earnings gets really, really small, it's possible you'll get a PE number that goes up to like 50 million or something. If you see something like that, so if you want to put a graph like this into your paper, which wouldn't be a bad idea, and we'll talk about this some after the Thanksgiving break as well. If you have 2 or 3 numbers that are just insane, then you can really just take those off of the chart. Just go find them and just take that out. So you just have a blank spot and that would be perfectly fine because it really can mess it up. That's the reason I'm doing medians and not averages because you can get that skewing in there. So I think I have okay data on EBITDA. You might, if you have something like this, you might delete the ones that don't have numbers in them just to make sure it's not messing up your medians. I don't think it is, but you have those numbers. And so over here, you've got their current EBITDA. Their current EBITDA is on the pace values page is 4708. That's their current one. And you can compare that. You have to bring in the percentile, just like we did before on the pace values. On the output. So that's the range that it has been historically from 0.779 to 3.31. Right now, they're at 1.43 versus 171. And what you want to do is say, okay, their current is right there. That's current. What would it be at the median? So you take the current times the median. divided by the current. You say it should be 39.25.2. Should be the current times the point 2 divided by the current. Could be as low as 21. And then you do the current times the 0.8 divided by the current relative. Could be as high as 85. Pretty wide range, what you'd expect on a firm like NVIDIA. So when you go into Capital IQ, it's already set up to do EV to EBITDA. So you'd run a scenario at 39.3, which is the median. You run a scenario at 2157 and run a scenario at 85.95. You got your range on the end. All right. So you got all your data on a firm like NVIDIA. It's going to be pretty wild, and it should be pretty wild. NVIDIA is a really difficult firm to value, so you can get pretty wide ranges, very wide ranges. It's not unusual for a firm like that. So, all right. So on Tuesday, I'll send out on my email tomorrow. So Tuesday, I'll give the option to zooming in. What I want to do on Tuesday is begin the workload on paper 6, which is a team. And I also want to do some work on your resubmitting previous papers as well. So I'll set that up and show you how you're going to do it. If you Zoom, how many of you are going to actually be here on Tuesday? Is that many of y'all? Hopefully a lot of y'all. So if you're going to Zoom in, I'll count you if you're on the Zoom attendance. So make sure whatever's in Zoom has your name in it, that you're not like, Betty Bop or something that doesn't relate to your name. So, all right, I'll stop it there.